Why would a person want a car? They're big, they're dangerous, they're smelly, they're expensive, but they get you where you need to go. People need to go places. We need to go to work, to school, to buy groceries, to go to the park. Maybe there's no good public transportation where you live and work. Maybe your city isn't safe for bicycles. Or maybe riding a bike just isn't right for you for various reasons. So let's say yes, you need a car. You want a car. How does a person get a car? There are two main options. You can either buy the car outright or you can lease it. When you buy a car, you either pay in full or take out a loan to finance the purchase. In the end, the car is yours, an asset you can keep for as long as you like. But leasing is different. Think of it as renting the car for a set period, say 2 to 5 years. During this time, you make monthly payments, usually much lower than your monthly payment if you were buying the car. But you don't own the car at the end of the lease. Instead, you return it to the dealership and go back home empty-handed. So, which one is right for you? Buying a car might seem like the more straightforward option. We buy things all the time. But let's take a closer look at what car ownership entails. First, you don't actually know how much a car costs. Oh sure, there's the sticker price, but that's just the start of negotiations. Car shopping usually involves haggling, like you're in some medieval marketplace. As soon as you step on a car lot, the salespeople start sizing you up, circling like sharks. Their goal is to make you pay the maximum price for the car. Your goal is to negotiate them down to the lowest possible price. What will you wind up paying? That's anyone's guess. And unless you're flush with cash, when you buy a car, you're not just paying the final price you negotiated. In most cases, you'll need to take out a loan. This means you'll pay interest on top of the car's purchase price. The amount of interest depends on your credit score, the length of the loan, and the terms you negotiate with the lender. If you want to see just how much more you pay for things when you use credit, we have a bonus exercise on our website, Socratica.com. Find the link below. We're not done. There's more. You never really just buy a car. You have to consider the total cost of ownership. You're responsible for more than just the monthly car loan payments. You'll have to cover maintenance costs like oil changes, tire replacements, and any unexpected repairs. As your car gets older, these costs can add up. Then there's depreciation. The moment you drive a new car off the lot, its value starts to drop. Cars lose a significant portion of their value in the first few years. If you plan to sell your car later, its resale value will be much lower than what you originally paid. But on the upside, once the car is paid off, it's yours. You won't have any more loan payments, and if you take good care of it, you can continue to drive this car for many more years without another large financial commitment. Back in the day, leasing was mainly for businesses and for the very wealthy who wanted to dabble in a variety of high-end vehicles. But leasing really caught on for the general public in the 1990s. From the seller's perspective, dealers often prefer leasing. Why? Because leasing can bring in higher profit margins. They get the car back at the end of the lease term and can sell it as a used car or release it, creating a steady stream of income. This approach keeps customers returning every few years for a new model. While dealers might offer enticing lease deals, remember that they're structured to benefit the dealer more than the customer. When you lease a car, you're essentially renting it for a few years. You make monthly payments that cover the car's depreciation during the lease term, plus interest and fees. Lease agreements often include specific terms you need to understand. You may be happy about the advertised low monthly payments. However, there are mileage limits, and exceeding them can result in costly fees. Additionally, if the car shows excessive wear and tear when you return it, you might face extra charges. Leasing can be very attractive if you enjoy driving a new car every few years and prefer lower monthly payments. But keep in mind, you're building no equity, and continuous leasing means you'll always have a car payment. Life is unpredictable. Maybe you need to quit your job and leave the country. Maybe you get married and you don't need 2 cars. Congratulations. In any case, if you need to end your lease early, you could face hefty penalties, sometimes owing the remaining balance of the lease. This is known as an early termination fee. Some leases offer a buyout option at the end of the term, allowing you to purchase the car. While this might seem appealing, it simplifies your life, and maybe you're attached to the car. The buyout price is often higher than the car's market value. If you're considering doing a buyout at the end of a lease, be sure to check the Blue Book value, as well as what cars are actually going for at used car dealerships. Crunch those numbers before deciding if it's a good deal. Now let's shift gears, and take a closer look at these 2 options. First, the details of car ownership and the total cost of buying a car. To start, there's the purchase price, the negotiated cost of the car. Car commercials always show the dealer handing you the keys and you're smiling. So fun! But the truth is, after you negotiate the price, you're in for hours of paperwork. During that time, you'll see the price of your car continue to climb. There will be sales tax and a whole bunch of fees to the government and various agencies. Unless you're paying cash, you'll also pay interest on your car loan, which increases the overall cost. For example, if you buy a $30,000 car with a 5-year loan at 5% interest, you'll end up paying about $34,000 in total. Depreciation is another critical factor. Cars lose value over time, especially new ones, which can depreciate about 20% in the first year alone. This means that the car might be worth significantly less when you decide to sell or trade it in. Maintenance and repair costs also add up over time. The upkeep of some cars is just more expensive, and it's hard to plan for this. As the car ages, it may require more frequent and costly repairs. When you factor in depreciation and maintenance, the real cost of ownership climbs even higher. Understanding the financial commitment of buying a car also involves knowing how car loans work. Car loans are much like other forms of credit. You borrow money to buy a car and repay it over time with interest. You'll negotiate with a bank the interest rate and loan term. The loan term is how long it will take to pay off the loan. Typical loan terms range from 36 to 84 months. For some reason, they like to say that instead of 3 to 7 years. Your monthly payment depends on the loan amount, interest rate, and term length. One trick to reduce your monthly payment is to come up with a down payment that reduces how big of a loan you have to take out. Another strategy to wind up paying less overall is to choose a shorter term. A shorter loan term means higher monthly payments, but less interest paid over the life of the loan. You can't escape all of this finance talk when you choose a car lease. When leasing, you're also financing, but instead of paying for the car's full value, you're paying for its depreciation during the lease term, plus interest and fees. Leasing might have lower monthly payments, but remember, you won't own the car at the end. The key difference is that financing a purchase builds equity over time, whereas leasing does not. We're going to slip in one more consideration, and that is, try to save as much as you can on your car so you can support our work on Patreon. Our patrons are so smart with their money. Thanks for thinking of us. Find the link below. Now, let's see a practical example trying to decide between buying and leasing a new car. Let's see how the numbers stack up over 3 years. You purchase a small, new car for $30,000 with a down payment of $3,000, leaving you with a $27,000 loan at 5% interest over 5 years. Your monthly payment would be approximately $510. After 3 years, you would have paid about $18,360 in total payments, and your remaining loan balance would be around $11,600. If you decide to sell the car at this point, which has an estimated resale value of $18,000, after 3 years, you could pay off the remaining loan balance and have about $6,400 left. Alternatively, if you lease the same car for 3 years with monthly payments of $350, you would pay a total of $12,600 over the lease term. At the end of the lease, you return the car and have no equity. You might also face additional fees for excess mileage or wear and tear. In this example, buying and then selling the car after 3 years could leave you financially ahead by about $7,000 compared to leasing, where you have no equity. However, this doesn't account for maintenance costs, which are typically higher for owned cars as they age, nor does it factor in potential lease penalties. The bigger factor for many people is simply how much money can they afford to put towards a car each month? We're not made of money. The extra couple $100 required for car ownership may be needed for rent, groceries, braces. What if neither of these options fit into your budget? Is there a more affordable path to having your own car? Absolutely. Buying a used car can be a smart financial move for many people. The lower purchase price is the most significant advantage. Used cars are cheaper upfront, and the biggest depreciation hit has already occurred, meaning the car's value won't drop as dramatically after you buy it. Insurance premiums and other fees are often lower for used cars, saving you even more money. However, used cars come with their own set of considerations. Older cars may require more repairs, and warranties might have expired, leaving you to cover maintenance costs out of pocket. There's also the risk of the unknown. Was there an accident that weakened the structure? Are there parts that have seen better days? The car's past might be a mystery unless it's a certified pre-owned vehicle. A certified pre-owned car is a used vehicle that's been thoroughly inspected and repaired as needed. The manufacturer's or dealer's warranty may also back it up, depending on their CPO program. The added work to qualify for a CPO can result in a significant price increase compared to other used cars. To mitigate these risks, always obtain a vehicle history report and have the car inspected by a trusted mechanic. Certified pre-owned options can provide added peace of mind, as these vehicles have been thoroughly inspected and come with extended warranties. Now, regardless of whether you buy new, buy used, or lease, another factor that affects the overall cost of driving your own car is insurance. You have to have it. So, how does insurance fit into this equation? The cost of insurance can vary widely based on several factors. The car model and age play a significant role. Newer, more expensive cars typically cost more to insure. Your driver's history, including any accidents or tickets, can raise your rates. Where you live also matters. Urban areas might have higher rates due to increased risk. Coverage options affect your premiums too. If you're leasing, the leasing company may require higher coverage levels, which can increase your insurance costs. And then there's the new versus used question. Insuring a new car might cost you $1,800 per year, while a similar used car might be $1,000. Over 3 years, that's a $2,400 difference, money that stays in your pocket. As you weigh all these options, there are still a few other factors to keep in mind that can influence your decision. Your credit score significantly impacts your loan terms and insurance rates. A higher credit score can get you better interest rates on loans and make it easier to get approved for a lease. Leasing companies often require good credit, so if your score is low, buying might be your only option. It's almost impossible to predict your costs exactly, so it's smart to budget for unexpected expenses. Repairs and maintenance seem to happen randomly, and you should set aside funds to cover them. Don't overlook fees and taxes either. Annual registration fees, periodic emission checks, and other charges come with the responsibility of having a car. Even something as simple as paying for parking is going to affect your overall budget. Long-term financial planning is also essential. Owning a car adds to your assets, which can be beneficial when applying for loans or building your net worth. Consider how a car payment fits into your overall financial picture and future goals. Are you planning to buy a house soon? Do you have other significant expenses on the horizon? Your car decision should align with your broader financial plans. You might find it helpful to review our lesson on setting financial goals. We'll share a link to that video. Has the choice become clear to you yet, whether you should buy a new or used car or lease instead? Let's up the stakes of our example with a more expensive car and extend it over a longer period to see if that makes the real cost differences more obvious. You purchase a mid-sized car for $45,000 with a loan term of 5 years at 5.7% interest, resulting in a monthly payment of $864. Over the 5 years, you pay a total of $51,840. After the loan is paid off, you own the car outright. If the car's resale value after 5 years is approximately $22,500, your total cost of ownership would be $51,840 in payments minus the $22,500 resale value, equaling $29,340. Alternatively, you decide to lease the same car for 3 years, with monthly payments of $535, totaling $19,260. At the end of the lease, you return the car and lease another one for the same terms. After 6 years and 2 leases, you've paid $38,520 with no equity to show for it. Over 6 years, buying saves you about $9,180 compared to leasing. Plus, you have the option to continue driving the car without any monthly payments after the loan is paid off, or sell it for its residual value. If you invest the money saved by buying, you could grow your savings even further. Also keep in mind, if you exceed mileage limits or incur wear and tear fees in a lease, your costs could increase. The key takeaway is always consider the total cost, not just the monthly payments. Understanding the long-term financial implications helps you make a decision that's best for your situation. Did you catch that part of the last example where your used car was still worth something if you were to sell it? We call that the resale value, and you should know how different car models that you're considering hold their value over time. This can significantly affect the financial viability of buying a car. Some brands and models depreciate more slowly, meaning they'll retain a higher resale value. This can make buying more attractive because you'll recover more of your initial investment when you sell. On the other hand, cars that depreciate rapidly can make leasing more appealing, since you're not bearing the brunt of the depreciation. Researching the resale value of different models can help you make a more informed decision. Resources like Kelley Blue Book or Edmunds can provide valuable information on how various cars hold their value. Ultimately, the decision to buy or lease a car depends on your personal circumstances, financial goals, and preferences. If you value long-term ownership, want to build equity, and there's room in your budget for higher monthly payments, buying could be the better option. If you prefer lower monthly payments, enjoy driving new cars frequently, and are comfortable with not owning the car, leasing could be more suitable. Remember, the smartest financial decisions are made when you're informed. Do the math, consider all the factors we've discussed, and choose the path that aligns with your lifestyle and financial goals. That's smart money. Just one more thing. If you want to #learn more about $finance, you can find extras on our website, Socratica.com. Quizzes, bonus materials, other helpful things.